Welcome back, guys. Thanks for tuning in for our last episode of this series, the best and worst stocks to buy in 2026. Today's episode includes, in order, Costco, FICO, Adobe, Nvidia, Oracle, SoFi, HIMS, Rocket Labs, and crypto altcoins. If you like what you see, please consider subscribing. It would mean a lot to me. And also let me know your thoughts in the comment section. One more thing is that at the end of the video, I'm going to put a screenshot up of the final tier list with every stock I've done in the series ranked in order, part 1 through this part 3. So make sure you stay to see that if you didn't watch the first 2 episodes. First on our list today is Costco. Costco is one of those businesses that has just an awesome business model. No other grocery store can or has successfully replicated what Costco has. The main reason I speak so highly of this model is because when they have billions in revenue coming in from memberships, they can keep their prices lower than pretty much all competitors, including the likes of Walmart. One of the biggest bullish catalysts for this company is its international growth. Costco is successfully exporting its business to China and Europe. International comparable sales are currently outpacing US growth, with Canada at 8.4% and 10.6% in other markets versus 6% in the US. Next is the potential for a stock split, with shares reaching over $1,000 in 2025. This makes Costco a prime candidate for a stock split, which is considered to be a bullish event for share price. Now I move on to why the company might be getting a lower rating than most would expect it to get. Of course, the valuation problem. This is the primary concern for me, of course, and the data backs it up. Costco is currently trading at a PE ratio of around 50x. This is over 30% higher than its 10-year historical average of 38x. You are paying 50x earnings for a company that is growing revenue at 7% and earnings at 8 to 11%. In a normal market, a 50x PE is reserved for growing companies at 25 to 30% plus. Lastly, as I spoke about earlier in Costco's ranking, is saturation limits. With over 630 locations in the US alone, the easy domestic growth is mostly done. Moving into fiscal year 2026, the company is slightly revising its new opening plans due to construction delays in markets like Spain. With all that being said, final verdict for 2026 is B tier. Costco is what I like to call a compounder in a cage. The business is doing everything right, but the stock price is trapped by its own expensive valuation. For 2026, I expect the stock to be a low volatility safety play. It likely won't beat the S&P 500 by a wide margin this year because it already pulled forward, if you will, those gains in 2024 and 2025. But its downside protection in a shaky economy keeps it firmly out of C tier or lower. Next is FICO. FICO has been a monster business for decades, but it has hit a massive regulatory wall in the last 18 months. FICO is currently a broken monopoly in my opinion. While its cash flow remains elite and its software business is a sleeping giant, the loss of its exclusive grip on the mortgage market is a fundamental shift that prevents it from being A tier, let alone S tier. However, the recent sell-off in the couple years has brought it down closer to a fair valuation, but the risk of further market share loss is real. The first thing I like about FICO is the software pivot. They are no longer just a credit score company. Their FICO platform is growing annual recurring revenue at 31% year over year. This is the ServiceNow style business buried inside FICO that most people ignore. Secondly is the pricing power. FICO scores are still incredibly cheap relative to the value they provide, which is $3.50 per mortgage pull. They can, and do, raise prices by 10 to 20% without lenders flinching because the cost of switching to a new model is so high. Third is their financial health. Their gross margins are a staggering 82%. They generate massive free cash flow, which was $740 million in 2025, and they use it to aggressively buy back their own stock. Over $1 billion was authorized as of June 2025. Now are a few things why it's held back in my opinion. The big sell-off we saw was caused by the Federal Housing Finance Agency. For decades, lenders had to use FICO. Now, they are allowed to use VantageScore 4.0, which is a competitor owned by the credit bureaus. So instead of needing 3 credit reports, all using FICO, lenders now only need 2. This effectively cuts FICO's potential mortgage revenue by 33% for any lenders that switch to the new system. Now's the valuation I referenced earlier. Even after the sell-off, it's not cheap, so to say. It trades at a 60 price to earnings ratio, while lower than its 90 ratio peak in 2024. It is still 23% above its 10-year average. One thing to mention that is one of the more bullish catalysts for this company, if you watch my last video when I talked about Ethereum, I talked about what I believe the Federal Reserve and the US government is heading towards in terms of interest rates. That, along with quantitative easing coming to our financial system, typically means more revenue for FICO due to the fact that borrowing money is cheaper. This leads to a surge in mortgage originations and credit card applications. Since FICO gets paid per pull, if you will, more loans equals more revenue. With all that being said, FICO's a B tier stock for the coming year. However, long term, I would throw this in A tier or maybe even S tier. Next on our list is one I'm a really big fan of. That's Adobe, especially at these prices. Adobe has successfully transitioned from a defensive stance to an offensive one. All the market is obsessed with AI startups. Adobe has quietly scaled its AI users to 70 million monthly active. You are essentially getting a world-class monopoly at fear-driven discount. My favorite part, of course, is the valuation. Adobe is currently trading at a forward PE of around 19. For context, its 5-year average is over 40x. It is literally trading at a 50% discount to its historical self. Continuing with the valuation, the free cash flow yield has climbed to just under 7%. In the software world, anything over 5% for a company with 90% gross margins is usually considered deep value. Another thing you love to see with stocks is buybacks, of course. With over $10 billion in operating cash flow, Adobe is aggressively buying back shares at these record low prices, which will supercharge earnings per share throughout 2026 and beyond, assuming prices recover. Next reason I also love Adobe is its parallel with Google and specifically Google Search. Unlike open source AI models, Adobe's AI is trained on licensed content. This makes it the only choice for Fortune 500 companies who are terrified of copyright lawsuits. 1/3 of Adobe's new business is now AI influenced. They aren't just talking about AI, people are paying for it through higher tier pro subscriptions and generative credit top ups. These credit top ups work like a machine in an arcade, if that's how you want to think about it. With 0 credits, you get some AI tools, but you are very limited. With 1 credit, you can access most common tasks like generative fill in Photoshop or generating an image in Firefly, which costs 1 credit. Premium features, which cost multiple credits, give you access to heavier tasks like text to video, generative extend in Premiere Pro, or high resolution 3D generations, which require more computing power and therefore cost more credits. Why I'm such a huge fan of this business model is because it allows Adobe to monetize heavy users like ad agencies much more effectively than a flat monthly fee. Once the AI model is built, selling an extra 100 credits has very low marginal cost for Adobe, meaning most of that top-up price goes straight to profit. In my opinion, the only true competitor Adobe has is Canva. However, they really have only grasped the students and freelancer market. Adobe still owns the institution and big money market, which is why I've decided to put this in A tier for 2026. Next on our list is the king, or at least the king of recent years. That is, of course, NVIDIA. NVIDIA has, without a doubt, been on one of the greatest runs of all times in terms of stock appreciation, and their metrics can back it up. The forward PE trades at roughly 40x, which for a company growing revenue at 50 to 60% year over year is technically cheap on a growth adjusted basis. Also, their PEG ratio, which is the price earnings to growth, is sitting around 0.7 to 0.8. Generally, anything under 1.0 is considered undervalued for a high growth company. Next, we're going to hop into their gross margins, revenue mix, and efficiency. First, for gross margins, despite fears of competition, they are holding steady in the 75% area. This is unheard of for a hardware company. They have the pricing power of a monopoly software firm. Next, for the revenue mix, the data center segment now accounts for over 85% of their revenue. The Blackwell cycle is currently sold out, and the Rubin platform, launched at CES 2026, is expected to start shipping in the second half of this year. Last is efficiency. Their free cash flow margin is over 40%. They are essentially a cash printing machine that buys back its own stock. They returned $37 billion to shareholders in the last 9 months alone. Now, of course, this is a great company. However, there are a couple risks that keep it out of S tier for me. Number one, the China factor, of course, and their customer concentration. China isn't a super big threat to me, as they just took a massive $4.5 billion inventory hit due to US export licenses on the H20 chips, although demand remains high if they can navigate the red tape. However, the customer concentration is really what I'm not a fan of. Their big four customers, being Microsoft, Google, Meta, and Amazon, are also their biggest potential competitors as they develop their own internal AI chips, which they have begun doing. NVIDIA is obviously a fantastic company. However, with the, I can't say it, customer concentration, I can't put this in S tier. However, it's still going in A tier. Still a great company to hold. Next is Oracle. This has been one that I've been a big fan of for a long time. However, the latest earnings report made me have a change of heart on the stock. And the primary concern for this was their free cash flow, which has shifted into a deep deficit. In the most recent quarter and into 2026 report, Oracle's capital expenditure ballooned to approximately $12 billion for the quarter, driving free cash flow into a staggering negative $10 billion hole. To put the scale of this spending into perspective, management has raised full year 2026 capex guidance to $50 billion, more than double what it spent just a year prior. In my opinion, this spending is way out of its weight class and is forcing Oracle to lean heavily on the debt markets. Unlike its hyperscaler peers like Microsoft or Google, who fund their AI buildouts through massive existing cash piles, keyword existing, Oracle's total debt has surged towards $124 billion, with interest expenses now exceeding $1 billion per quarter, and a debt to equity ratio that has climbed towards 4x to 5x. The company's financial stability is increasingly tied to the hope that its massive AI backlog converts into cash quickly enough to prevent a credit downgrade. However, this isn't all bad news, and there is a bull case. For Oracle, this rests entirely on its remaining performance obligations, which reached a record $523 billion in early 2026. This massive backlog, fueled by high-profile contracts with Meta, NVIDIA, and OpenAI, suggests that the demand for Oracle Cloud infrastructure is genuine and pre-booked. Larry Ellison's strategy is to wait until the contract is signed before purchasing the necessary chips and hardware, theoretically ensuring that every dollar of negative cash flow today is tied to a guaranteed dollar of revenue tomorrow. However, this creates a concentration trap similar to what we discussed with NVIDIA, but with higher financial stakes. Oracle is effectively acting as the landlord for a handful of AI giants. If OpenAI or other major customer face, if OpenAI or another major customer face a liquidity crisis or a pivot in their infrastructure needs, Oracle would be left holding the bill for tens of billions of dollars in specialized hardware and data center releases that are already on its balance sheet. While Oracle's revenue growth of 14% and its record backlogs are impressive, the fundamental quality of the business has changed. It is no longer a compounder that operates within its means. It is a leveraged bet on the continued hypergrowth of generative AI. For investors seeking high-quality metrics, the combination of negative free cash flow, ballooning debt, and high customer concentration makes Oracle a C-tier stock. It possesses the potential for an S-tier recovery if that $523 billion backlog converts seamlessly into cash by 2027. But until their cash flow returns to positive territory, it remains a speculative play rather than a foundational one. Next is a retail favorite, SoFi. SoFi is arguably the most emotional stock on our list because it captures a generational shift in how people view money. Like Robinhood, it has successfully built a lifestyle brand around banking, specifically targeting the high earning, not rich yet, or what some people call Henry demographic. Although the biggest weakness for me is again its free cash flow. As of January 2026, SoFi has reached a massive milestone of 12.6 million members, representing a 35% year over year increase. More importantly, their product count is growing even faster, up 36% to 18.6 million, which proves their cross selling strategy is working. When a customer joins for a student loan refi, but stays for a mortgage, a credit card, and a high yield savings account, the customer acquisition cost drops to nearly zero for those subsequent products. Financially, the company has hit a critical inflection point. In late 2025, so far reported record adjusted net revenue of $950 million for the quarter, up 38% year over year. Unlike the Oracle situation where revenue grow is overshadowed by debt, SoFi is actually scaling its margins. Their financial services productivity loop has pushed net income up to $139 million in the most recent quarter, proving that they can be consistently profitable under GAAP standards. Now let's get to what I mentioned, that being free cash flow concerns. In traditional tech companies like Nvidia or Oracle, free cash flow is the gold standard. However, SoFi is a chartered bank. In banking, cash flow often looks negative when the business is growing because every new dollar a customer deposits or every new loan SoFi issues is technically a movement of cash that doesn't show up as operating cash flow the way it does for a software company. Instead of free cash flow, we have to look at tangible book value and net interest margin. SoFi's total book value grew by over $1 billion this year, to over $5.3 billion. This means they are getting richer as an institution, even if traditional free cash flow metric looks messy. They are currently maintaining a net interest margin of 5.9%, which is significantly higher than big bank competitors like JP Morgan or Bank of America, largely because SoFi doesn't have the overhead of physical branches. All that said, I'm ranking this a B tier for those reasons I mentioned. To move into A tier, SoFi needs to prove its technology platform can become a true AWS of fintech. Currently, that segment's growth at 12 to 15% is lagging behind their banking growth of 35% plus. If they can start signing major legacy banks out to their tech stack, they become a high margin software play rather than just a high growth bank. Also, one thing I forgot to mention to go over is the valuation, trading at roughly 45 to 50x forward earnings. It is significantly more expensive than traditional banks, which trade way down at 10 to 15x. You are paying a heavy premium for that younger generation capture. Now we're moving on to HIMS. HIMS is a tough one for me. It's got an amazing business metrics, but lives in an industry that the market refuses to fully trust. If we strip away the industry labels and just look at the raw numbers from the latest 2025 and 2026 early reports, HIMS is arguably executing better than almost any consumer tech company. They exited 2025 with revenue growth of roughly 49%, hitting a massive milestone of nearly $2.3 billion in annual sales. Unlike many growth stocks, they aren't just buying growth. Their gross margins sit at an incredible 75%, and they have transitioned into consistent GAAP profitability, reporting over $120 million in net income for 2024 and maintaining positive earnings through 2025. The member base has surpassed 2 million subscribers, and more importantly, they are successfully verticalizing, meaning they are building their own pharmacies and fulfillment centers to control the entire supply chain and protect those high margins. So that all sounds great, but the reason the stock struggles to stay in A tier and get rewarded with great performance is because of its industry, specifically the regulatory and competitiveness of it. A recent explosion in HIM's stock price over the past years was largely driven by their move into compounded GLP-1s, which are weight loss drugs. While this was a great move that added hundreds of millions of dollars in revenue, it is a high-risk strategy. As of early 2026, the FDA has largely resolved the shortages for branded drugs like Ozempic and Wegovy. This puts HIMS in a precarious position. If they can no longer legally sell compounded versions, a significant chunk of their 2025 growth engine could evaporate overnight. Furthermore, the competition is no longer just other startups like Roman or Keeps. They are now fighting with Amazon Pharmacy and the pharmaceutical giants themselves, being Eli Lilly and Novo Nordisk. For my final ranking, I'm going to be putting HIMS in B tier. The reason is you cannot ignore a company growing at 50 to 75% gross margins and positive free cash flow. However, the moat is still paper thin in my opinion. HIMS is essentially a world-class marketing logistics engine, but they don't own the intellectual property of the drugs they sell. Until HIMS proves that their personalized meds, where they mix multiple ingredients into one pill, can protect them from generic competition and regulatory crackdowns, they remain a show-me story, if you will. They have the metrics of an S-tier company, but the existential risk profile of a C-tier company, which averages out to a B in my opinion. Next is a fun one, Rocket Labs. This is a true test for investors. You either see a world-class aerospace pioneer or a dangerously overvalued science project. And there are some real red flags behind the scenes, but there's also a nuance in their business model that makes it different from the SPAC trash of years past. The primary reason to stay away, and the reason I most likely will be, is the valuation versus reality gap. Rocket Lab stock has surged over 170% in the last year, largely driven by the SpaceX halo effect, which is just speculation around a potential SpaceX IPO in mid-2026. From a cold hard metrics perspective, Rocket Labs is currently trading at roughly 50 to 80x forward sales. To put that in perspective, Nvidia, the most profitable company in history, trades at a fraction of that multiple period. Rocket Labs is still losing money on a GAAP basis, posting a net loss of nearly $200 million over the last 12 months. They are essentially hemorrhaging cash to build the Neutron rocket, a medium-lift vehicle designed to compete with SpaceX's Falcon 9. If the first Neutron launch, slated for mid-2026, fails or faces significant delays, the speculation premium could evaporate in a single afternoon. Now, no, it's not all bad news and speculation. There are some hidden qualities here. The first being space systems. Most people think of Rocket Labs as a rocket company, but in 2026, over 70% of their revenue actually came from building satellite components and software. Unlike other space startups that went bust, Rocket Labs has operational success, a massive backlog, and a path to cash flow. They completed a record 21 successful launches of their small Electron rocket in 2025. They entered 2026 with a $1.1 billion contract backlog, including a massive $816 million deal with the Space Force to build missile tracking satellites. This moves them from startup to defense prime, putting them in the same room as Lockheed Martin and Northrop Grumman. Analysts project the company could hit positive free cash flow by late 2026 or 2027, provided the Neutron development stays on track. For those reasons, this gets a D for my personal investment criteria. However, for somebody willing to take on more risk, I think this is a C or maybe even a B tier stock. Last, we got what is probably the riskiest asset class on earth, altcoins, specifically crypto altcoins, if you will, meaning every cryptocurrency outside of Bitcoin and Ethereum. Historically, the bull case for altcoins was based on rotation. Bitcoin would go up, and then the wealth would trickle down into smaller, riskier coins. in 2025 and 2026, that psychology is essentially broken. According to a recent report from Wintermute, the average duration of an altcoin rally has dropped from 60 days down to just 20 days. Liquidity is no longer rotating, it is concentrating. Institutional money is buying via ETFs, which is staying in Bitcoin and Ethereum, leaving the thousands of smaller altcoins to fight over a shrinking pool of retail liquidity. Next is arguably the most important part, being revenue. While some platforms like Solana or Hyperliquid have begun to tout, quote, on-chain revenue, this revenue doesn't function like a dividend or a stock buyback. In most cases, that revenue is just a measurement of how much users paid in transaction fees to speculate on other tokens. Furthermore, the token unlock problem has reached a crisis point in 2026. Many altcoins launched in 2023 and 2024 are hitting their vesting schedules, flooding the market with billions of dollars worth of new tokens because there's no SEC mandated quiet period or standardized disclosure. Retail investors are often exit liquidity for venture capital firms dumping their coins. I don't think I need to go any more depth in this. Within my portfolio, this would rank at the bottom of the barrel as something I would never put my money in. All right, guys, that's it for this series. I think at the end of this year or sometime in late quarter 4, I'm gonna come back to this and check on how my rankings are. Obviously, you would hope that the S tier ones perform the best, then A, B, C, and D perform the worst. I'm sure I will make some mistakes. Some of my C or D stocks might perform better than a S or A tier stock I put in here. I don't know. But anyways, I'm obviously gonna be starting some new some new series and new videos coming out later this week and next week and the time to come. So if you enjoyed this and you want to watch the other parts, make sure to subscribe and turn on the post notifications. See ya.